Hello, this is Steve from thegrashka.com. Today we have on our trading blog featured trade number 43. This is a put credit spread on Play. Play is the ticker symbol for Dave & Buster's. If you remember earlier, we have had an earnings trade on PRGS and it didn't go so well. And this one was made one day before on March 28th in anticipation for the earnings announcement after the closing bell. So what we did here was we sold a put combo on Play. Play is, by the way, having the underlying Play has like somehow double the average activity of PRGS in a day. So going back to the put combo that we sold a put combo by selling the 55 put strike expiring on 24 days on April 21 and bought as a hedge the 50 strike put option, and this gives us a risk of 500. That's like 55 minus 50, the difference of 5 times the 100 equity multiplier, so that's 500 minus the credit that we received beforehand for selling this combo. That means 50 minus 59 cents, that's 48.41, and voila, you have the max risk or the max loss if ever everything goes wrong of $450.59. The thing is, you would ideally not wait until everything's through and through, and with options there are just more options to avoid these types of scenarios where you have to like just take the full hit. There are a lot of sub strategies that you can go to in case a trade gets attacked or goes wrong. But for now, we discussed how the put credit spread went, and so on the next day, their earnings announcement was better than expected. Well, I think Play has statistically or generally a better than expected result when it comes to earnings. But in any case, if we should view the chart, okay, we're still on PRGS. Just one moment. Well, as you can see, the stock is historically has always been on an uptrend, and on March 28th, after the opening bell, we put a put credit spread on here, the 55 strike, and our hedge was on the 50 strike. So if the price of Play goes to 55 or lower than that, you will really have to suffer a loss until you will have to swallow a loss, or we will have to swallow a loss, or get creative with rolling over some positions. But since this is an earnings trade, generally we don't want to do that. We just want to get in on 28, and after the market, if the earnings gets announced, we would like to, after the market opens on March 29, we would really close this out since this is an earnings trade. On a normal trade, there are more options, but yeah, let me correct myself. On an earnings trade, we would just like to close out with as little loss as possible if we get to a loss. The thing is, because of this IV crush, the options that we sold more expensive the day before got really cheap on the day after. So even if the price went a little bit against us and it dropped maybe from 60, 62 to 60 or even 59, we were able to actually buy back the sold combo for $19. And we paid transaction fees of $2.19. Whammy. That generated us a profit of 28.22 US dollars based on the max risk of 450.59. And our actual profit that we reaped is 6.26% for 1 day. 1 day of holding this position. Annualized, of course, that's much, but this is not something that you'll get every day. And as you see on other earnings trades, you really have the risk of losing. And the most important thing, I think, to take away when you plan on doing the earnings trades is to bank on the high IV. And high IV actually just simply means that high IV helps boost the price of the option, so you would actually want to sell high and buy low, as they always say in the trading world. So you buy back your combo on a low IV environment, and this generates us our profit. So this is Diana, wishing you success in trading. Goodbye for now. Keep in touch.